joining us today. My name is Andrew Gardner, Senior Regional Sales Director for all things investments at Beneva. So when we were discussing what we'd like to talk about today, there's lots of great speakers. I saw a slide from the previous presenters saying it's better to plan than to litigate. And that does kind of segue nicely into what I'll be talking about today, which is the financial advice life cycle and how to use the Beneva savings and investment platform to put you in the best position to take on the inevitable changes in people's investment patterns, changes to their lifestyles, changes in age, changes in all those things, right? So I'll be covering a lot of stuff today. You are not alone. I have myself and all of my savings and investment colleagues, as well as all of my insurance colleagues that are here to help. We're across the country, right from British Columbia right out to Atlantic, Canada. So wherever you are, if you need to know who your sales representative is, you can simply reach out to me and I can direct you, or perhaps it's even me, and I'll be able to take care of you. So when we're thinking about the financial advice life cycle, I've seen lots of different presenters talking about all these different facets and different things that can change. Realistically, it really comes down to two main portions. There's an accumulation phase and there's a distribution phase. So the accumulation phase starts early, it's very, very long, and the distribution phase is near the end when we're actually starting to draw money out of the plan. So just quickly, some key differences. Accumulations, when we're going to be making periodic deposits, we're going to be using a risk tolerance questionnaire to figure out exactly where the client's risk tolerance may be. Some easy rules of thumb is 120 minus the client's age equals their equity holdings. So 120, we'll say I'm 50, is 70%. So I'd be 70% equities, 30% in fixed income. Chances are you're going to be a balanced person, a growth person, or aggressive. So you're going to lean more towards the equity side. Again, you got very long time horizons, and we're targeting returns somewhere in that 6 to 8% range. Over a very, very long period of time. Really what we're trying to do is post returns that are above inflation. So we don't have a tremendous need for capital protection, and death protection is really handy. We don't want to pay up for it though, especially when we're in the younger ages. We want to accumulate as much as possible. We want to keep fees down as best we can. And then we're going to take advantage of some tax planning arbitrage opportunities using different buckets to slide money from a TFSA to an RSP when the income levels are higher, and we can get more mileage out of our RSP contribution receipts. So we'll just stay on that side of the ledger right now. We'll talk about the accumulation phase a little bit more. And it does create one major problem that I kind of touched on, and that is we are going to have to take a look at more equity within the portfolio. We did have, it's coming off a little bit with markets doing so well over the last little while, but I can tell you last year we hit our yearly numbers in GICs in January. So at that point in time, everybody was rolling into GICs. I got no problem for certain clients. Maybe they should be there, but if you're in the accumulation phase, you probably are not probably, you're going to have to take on more equity risk. So here's a little slide that shows a rolling 5-year GIC average is obviously the orange line, and the purple one is a balanced portfolio. So yes, the orange line is very flat and not very volatile. And that is exactly what you might expect from a GIC. The purple one does have some bumps along the way, but obviously the return profile over the very long term, over the 20-year period, is vastly different. So when we say accumulation, we mean accumulation means growing, but it doesn't just mean growing, because obviously 15,000 is more than 10,000. We need to grow it faster than inflation. So this is from the Bank of Canada. The website's on the screen there. You can go in any time frames and kind of put this stuff in. $10,000 in 2004, for when this slide was done, would cost $15,438 today. So the same basket of goods that cost 10 grand 20 years ago costs 15.4 today. So if we look at that number, 15.4, we're getting very, very close, actually slightly higher than what the rolling GIC periods would have produced. So again, that means that we're going to have to take on a little bit more equity risk in the accumulation phase to try to post numbers that beat inflation and protect capital. And we've got lots of different ways that we can do it. Again, growth, balance, aggressive, more out there on the risk spectrum, and hopefully producing greater returns over the long term. Short term, I have no idea what markets may or may not do. I do know about probabilities. The longer the time horizon, the greater the probabilities are for success. Now, this does create some issues with clients because some clients are not necessarily built to take on as much risk. So we do have to figure out where exactly they sit, and we will have to figure out how we can convey this idea that you're going to have to ride with some volatility just because the rolling risk-free rate of return is not going to get them to where they need to get to. We want to keep clients off the ledge. So in order to keep clients off the ledge, we're going to have to mitigate all the points of risk that we can. So we can do that. First off, we have to figure out what the risk is. So we have a questionnaire like most companies do. There is 8 questions, no wrong answers. Client fills it out and they're either conservative, moderate, balanced, growth, or aggressive. When you have a long-term time horizon, the way the questions are scored, it does kind of push you into the more balanced growth and aggressive profiles as you might expect. If you have a long-term time horizon, if you have the ability to at least hold when markets drop, you are likely to be in a balanced growth or aggressive. If you have a very short-term time horizon and tell us that if the markets go down, you're selling everything, that's when you're in the conservative or moderate profiles. So we figure out the client's risk tolerance, and then we built a diversified portfolio. Most people have seen these quilt or jelly bean charts in the past. It rotates. Asset classes can be at the top, they roll over, they're not at the bottom, they come back up. There's no rhyme or reason to the colors and where they rank year from year to year. 2023 US stocks were the #1. I anticipate that that's likely to be the case again this year, but in 2022, they were the lowest. The only rhyme or reason that sits here is the white bars, which are the balanced portfolios, which kind of sit in between, right? It's like taking the middle lane on the highway. You're not in the fast lane, not in the slow lane, you're sitting in the middle lane. And we're able to kind of create any portfolio you want across all the different spectrums of risk, and we're going to mitigate it by breaking those individual pieces down into different buckets so that we are not overly exposed into one section or the other. I can tell you anecdotally that the money is flowing very heavily into US stocks. In particular, it's flowing very heavily into US growth or hyper technology type positions. They've done extremely well. The numbers look really, really good. And we really want to be avoiding chasing the returns of the previous cycle. Not likely to be repeated, as this chart kind of shows. Sometimes you get a couple of years, but then they end up reverting back to the mean. So in the accumulation phase, or anytime we're looking at this, advising across the life cycle, we want to start with the end in mind, right? So whether it's a finance, a need, a want, or a dream, get clarity around these goals. And that'll create the context of which everything else flows. But ultimately, we're looking at it as accumulation or distribution. They're going to be in either of those or transitioning between the two. And we do need to manage liquidity for each goal. With Beneva, we have the ability to use a mini self-directed approach where we don't manage the money ourselves. We hand the keys to portfolio managers, some of the best in Canada. And then we have different types of offerings depending on where the client is within this accumulation and distribution phase. And then we have creases in our contracts that are not common in the insurance world that you're going to be able to take advantage of. And we have to navigate a client from where they are to where they're going to get to and take advantage of arbitrage situations with tax, as well as make sure that we're creating or putting ourselves in a position where we're able to pivot and not cause further problems down the line. We may not know exactly what the future holds, but we want to be in a position where we're nimble and we're able to move. So accumulation phase, long-term, try to keep costs down, try to drive as much return as possible within the client's risk structure with a diversified portfolio. And then we get into the distribution phase. And now instead of periodic contributions, we're talking about periodic redemptions. The client still has a longer term time horizon, longer than most people may expect. The distribution phase may actually last a long time. Now, we're not necessarily trying to generate those larger equity focused type returns. It's going to be a bit more muted. We're looking at 4 to 6%. We're actually looking at protecting purchasing power. So we're trying to make sure that we're at least hitting the inflation type numbers so that we're not eroding the client's purchasing power over the next several years or as long as they're in that distribution phase. So now we start to feel a bit more capital protection, 100% death protection, those types of things. And we want to, at all costs, avoid litigation, as the last presenter mentioned. But a big deal is we want to avoid tax leakage. So when we're talking about this distribution phase, the number one point there is periodic redemptions. This is the critical part of managing across the life cycle. When we get into the distribution phase, the sequence of returns is the biggest deal. So on your screen, you can see $100,000 invested. This is accumulation, right? So 100,000 goes in, there's no withdrawals. And at the end of 15 years, you can see the rates of return. If you see the individual calendar year rates of return, they are different for investor A and investor B. Investor A starts off with very strong returns early, not so good late. Investor B flips that, has poor returns early and strong returns late. At the end of the day, when you're in the accumulation phase, it doesn't really matter. You're going to have ups and downs. Different things are going to do different things at different times. But over the long period of time, the sequence of how those returns got there is not really relevant. It does become extremely relevant when we flip the switch and now start to take money out, where you start with $100,000 and now you're taking out $7,000 a year at the end of the year. The returns for A match they're the same. So it starts off strong early and goes weak late. Whereas investor B, again, starts off weak. And as it turns out, they're not even there for when the returns start to get buoyant. So this is why it's really handy to have access to a contract where you're able to hold multiple different types of products all within one place. And what my favorite thing to do with clients in the distribution phase is, first off, take the questionnaire. Let's figure out exactly where they are. We want to keep clients off the ledge. Now, we are going to likely be reducing volatility because the client's older, their time horizons are getting a little bit muted. They have less likely to be in equities, but it's not necessarily the case. One way or another, though, in our universe, they will be starting to withdraw the money. That's what the distribution phase is. So we can create a cash wedge, 2 years worth of income. Some people like 3, whatever you think makes the most sense for you. We're able to hold that position within a GIA. And then in this example, we have a balanced portfolio for the rest. So if I take a balanced portfolio at 2 years worth of liquidity buckets with the GIA, overall, this is going to be something less than balanced in terms of its risk structure. But it creates that sequence of returns. Now, I'm not as worried about it because I have at least 2 years worth of income, meaning I don't have to tap my equity positions in order to redeem units to solve for a liquidity issue. So having all of these things all together and being able to manage that sequencing of returns, you can also tell the client if markets are going down, you don't need to worry about that right now because we've got your next 2 years worth of income sitting within this cash wedge position. That money comes due within a GIA, and then we're just gonna redeem it out from a daily interest or a very short-term vehicle where there isn't really any volatility. So this is a critical kind of thing. This is what gets people in trouble. They bank on it. They see kind of reports and things like that. It says, oh, if I get a 6% rate of return, I'm going to be great. The problem is it's never 6% in a straight line. The sequence of returns are going to move. So we do need to make sure that we're protecting clients for this eventuality and that they will be taking money out of these plans, and we need to be prepared for it. So at Beneva, I am spoiled for choice. I have things that take on market risk, which are investment accounts. I have segregated funds, which also take on market risk. The investment accounts are the big deal at Beneva. These are for registered plans only, though. So these are for RSPs that'll eventually become RIFs, LIRAs, which eventually become LIFs, and TFSAs, which in a lot of cases, people will flip the automatic redemptions on when they get to the distribution phase, and that allows them to pull money out tax-free. It helps with planning when it comes to things like OAS clawback and other types of things. We're able to navigate some of the taxable income stuff by using TFSAs in that fashion. Again, we have the ability to do automatic redemptions from ours. We have laddered GIAs, equity index GIAs, which are very, very niche type product, but can be super helpful, high yield accounts, immediate annuities, and we do IPPs. For our purposes today, what we're really looking at, though, are the top two kind of buckets for most of it, right? So accumulation, transition, distribution. So in the accumulation phase, if it's registered money and you call me, the strong likelihood is that I'm going to be recommending the registered investment accounts. Again, they can only be used in registered plans. So registered plans, these are insurance products sold through your IDC contract, who has a contract with us. They're not for sale anywhere else. You can't go to your self-directed account at a banking facility and buy investment accounts. The only place you can get them is you have to deal with an insurance licensed broker who has a contract with an MGA, who has a contract with us. The key part here is that it's mutual fund pricing. So it's same fund, same MER for registered plans. It comes with 100% death benefit. In registered accounts, we're going to be using these to accumulate. If my fees are lower, clients, the fee situation has been, in my opinion anyway, blown out by media and things like that. I talk to brokers every day. It's rare that we get a lot of conversations around fees, but there is a corollary to that. The lower the fees, the better the returns, all things being equal. So the investment accounts are mutual funds. We just pick them up and drop them into an insurance blanket. We use mutual funds. They come with A-class retail mutual fund pricing. We have a death benefit. The mutual funds don't. So it's kind of a layup. If it's non-registered money, we're going to be using the 75-75 contract because it's a bit cheaper, and we want to keep those costs down. We want to accumulate as much as possible, post numbers that are above inflation rates as best we can. When you're transitioning and moving between these, or you could see it on the horizon, you have a conversation with a client that I think I'm done working maybe in a couple of years, we're still going to be using these registered investment accounts. We're not going to move from there. In the non-registered world, maybe we start to take a look at adding the death benefit to it, rotating from a 75-75 to the 75-100. We have that equity index GIA, which is effectively a blend between a GIA and an investment account. They come in 5, 7, and 10-year terms. They have 90, 100, 110% maturity guarantees over those 5, 7, and 10 years. So they work really well to put some guaranteed outcome within a plan so that you come back in 10 years, we've got this position, you can't lose money on it, right? So this is a way to kind of keep clients calm, keep them off the ledge, have these liquidity buckets that are built so that as we're going through the investment life cycle, we've got all our ducks in a row and we know exactly what everything's going to be doing. Now we rotate to the distribution phase, again, likely to start going maybe down a notch or two to balance moderate conservative. We're not getting out of the investment accounts. We'll just flip the switch, run the RIF, run the LIF, have those paid out. As you take money out, obviously the death benefit goes down, but we take a ton of money from mutual funds because mutual funds don't have any guarantees. In order to get into the investment accounts, so you do have to get in the door before the age of 75 to retain that 100% death benefit. If money comes in after, we still have a death benefit, but it drops to 75%. So you got any clients that you're working with right now that you know owns funds and they are in registered plans, get these things open, get that money moved, put the 100% death benefit on all the contributions that go into the Beneva plan before the age of 75. If they have segregated funds and they're in registered plans, we can take a look at that. Perhaps they're at market values. They should be at market values that are well above what their death benefit currently is. Rotate that to Beneva investment accounts. That is now the death benefit with us. So you've increased their death benefit, you've lowered their MERs, and I'd put our managers on par with any mutual fund company as well as any segregated fund company that's in operation today. Non-registered, now we can maybe, if we didn't, that 75-100 contract or the 100-100 contract, start to look at cash wedges for GIAs. We have annuities that we can build in here to take care of some fixed income needs. Take that, relieve that stress. X amount's going to hit your bank account every month for the rest of your life. It could be a spousal survivor annuity, term annuities, whatever you want to do, we can do. And we do have pre-authorized transaction programs that can run all of the distributions, right? So wherever you want this money to come from, we can take it and have it run as smoothly as possible for clients. Quick case study, I call it my strongman portfolio. This is where we're going to be layering in different aspects of what Beneva has to offer. We're going to be able to lower fees dramatically, and we create a runway for the more volatile positions to try to take the sting out of those sequence of returns that can play clients up and trip them. So in this example, you got a 65-year-old client, $500,000. It's in an RSP. We'll take 20% of that and put it into a GIC. That's going to be, when time comes, we've got money that cannot go down. The rates at Beneva are quite competitive. We're going to know to the penny what that's going to be worth when the term is up. We're going to take another chunk, use that equity index GIC. We'll say a 10-year position, 100% maturity guarantee. So the money cannot lose. We'll take that portion to be there in 10 years. We will use the TD low volatility pool blended with a percentage that sits in a GIC, a 10-year GIC. And then in this case, because it's registered, we're going to be using investment accounts for 50%. So on a fee basis, like clients who are interested in fees, we use this all the time to take money out of F-class IROC brokerage firms. And for certain clients, you've got an MER of 0 for the GIA. The equity index is technically 0, but there are embedded fees for the portion that sits in an investment account. So say 0.57. My standard MER for the investment account, same fund, same MER, is about 2.3. So 50% of 2.3 is 1.15. Add them all up, you're running this entire portfolio plan for 1.72. You got guaranteed rates of return, managing this, the sequence of returns with the GIC. You've got a no-risk position in the equity GIA. And then you have investment accounts, which do have some volatility. It also has daily liquidity if we need it. And we can build investment buckets that make sense for that particular client. And we're doing it all for something that is extremely well priced. Again, the lower the price, it does help produce strong returns. So registered cases, we can do all of these different things. It's all one contract. The client logs in, they could see it. All their positions are all going to be laid out for them. Non-registered, leakage, no bueno. We want to avoid leakage as much as possible. The best way to avoid leakage is to make sure as much money goes out of the tap at the end and that there's no money that leaks. Money can leak before it gets out to the end, basically by paying taxes along the way. So the rules of tax planning are you want to defer it as much as possible. This non-registered, so I can't use investment accounts, we have to use the segregated fund platform. We have 3 different guarantee structures, 75-75, 75-100, 100-100. So you can see how managing across a client's life cycle can be done by moving between these various guarantees. I will spend a quick second to remind everybody, we have this 100-100 contract, not everybody does. And we have the ability to open the contract at right up to age 85. Open the contract. $500 will open a contract. You can then dump money in after up to age 100, and whatever you put in here is going to have 100% death benefit attached. So you never know when these situations may come. The client just wants to make sure that their beneficiaries are going to get at least this amount, but they don't really need the money. So it's not really a distribution phase situation. It's to protect the beneficiaries, and they want 100%. The maturity guarantee is at an 85-year-old is probably not relevant. It's there, but it's the death benefit that counts. They're living at home right now. Put $500, get the contract open, get all the estate beneficiaries lined up, all that stuff settled while the client still has all their faculties, no power of attorneys, none of that stuff. It's done, $500. Now, they sell their house, they're 93, they got $1 million. They can dump it in here, and that million would be 100% protected upon death. So the best thing about us, and not everybody does this. In fact, there's only one other company that I can find, and if I'm wrong, please forgive me, is that you can rotate with Beneva between the different guarantees. So you can go from a 75 to 75 100 to 100 100 and down if you want. So you can do it once a year. With us, it's a change of guarantee option form that you just tell us what you want to do. The key point here is that there's no deemed disposition. Other companies, you have to sell the 75-75 and then buy the 75-100. That change for most places is going to trip a deemed disposition. With us, it doesn't. And again, you can go forwards or backwards. Client's super nervous right now, telling you they want to go to cash, the world's going to end. Why don't we just put it in this 100-100 contract? You can't lose. It's contractually guaranteed. And then in a couple of years when the world actually doesn't end, we'll rotate you down into the 75-75. You can do it once a year. Again, no deemed disposition. It's a very big deal. This is us versus one of my competitors. We have virtually the exact same fund. So we're both using the same reference position. So that's why I use it. Maybe not the greatest example because the thing's done so well, but in a short period of time, but it did happen. So let's take a look. $200,000 goes in back in August of 2022. That 200 has grown to 268. Say this client now wants to change from their 75-75 to the 75-100. Okay, at the current place, they would have to physically sell it and buy that new contract. That is going to produce a capital gain of $68,000. Capital inclusion rate is 50% on that amount. We'll say the marginal rate is 50, probable, as it's a fairly large taxable gain that's going on to someone who has $200,000 in a non-registered account. In any event, the client then now has a tax liability of $17,000. So they will have to sell a position in order to cover the tax liability of that, or figure something else out, use up RSP contribution room, which you don't really want to do, or maybe there's some other tricks you may have. The reality is clients won't do it. They're not going to take the tax hit today to move to a better guarantee structure. With us, they don't have to worry about it. They change the guarantee. There is no capital gains. There's no capital gains inclusion. Doesn't matter what your marginal tax rate is. The tax liability is zero. So we start people off at 75-75s, unless there's a specific thing where the client's going to be turning 75 shortly, then maybe we do start at the 75-100. But for general purposes, 75-75, keep the costs down a little bit. And then you control when you want it to roll. So say the markets go up dramatically very shortly. A lot of places have death benefit resets every 3 years. Some are 1, some are 3. If something happens in the meantime before you get that automatic reset with my competitors, and maybe you wanted to change it, with us you can. You send in the form, we just change it. And whatever the change goes to, that starts the clock on the maturity guarantee, and it also resets that death benefit. So in this case here, the 268 now becomes 100% death benefit if we rotated it from the 75-75 to the 75-100. I got great portfolio managers in both investment accounts and seg funds. These are the seg fund ones. They tend to be a bit more pension institutional style. Work with me, work with my colleagues. We can build a portfolio that could suit anybody. We do have a private wealth management platform. It does take $500,000 to get in. It is a family threshold. So not spouses, not households, not postal codes. It's anybody that's a direct relative of the main person, including in-laws. So I'm not sure how direct that is, but that everybody can be folded in. And if we get over the threshold, we start to discount the management fees. We have things like auto rebalancing and things like that, which can be a bit tricky in non-registered accounts. So that's something we can talk about. It has very transparent reporting. Some people like that, some people don't. The transparent reporting does have one major advantage. It allows the tax deductibility of the fees within non-registered plans. They'll get a statement, there'll be a fee section on the statement, hand that to the accountant, and that's what you can take off in terms of carrying charges. So when it comes to the distribution phase, obviously estate planning is the ultimate final distribution. I know everybody on the call knows all the benefits of segregated funds in terms of bypassing probate and all those other types of things. So just keep that in mind. We can avoid probate fees, more leakage. We can also have the death benefit paid out as annuity. Not everybody has that. That's becoming more and more of an option. You can have it lump sum, annuity, percentage. One kid gets one thing, the other child gets another, whatever you want to do. And another key thing for us of managing across the life cycle is that on our application, we have both contingent and continuing beneficiaries. So depending on what you want to do, we can do it. Most people, everybody has contingent, but very few have continuing rather, right? So ultimately, lots of choices, lots of investment things to look at. Build portfolios, reach out to me. I do a lot of hypotheticals. We can take a look at what the client currently owns. We can build a portfolio that suits, that matches. I do a lot of these things and I don't generally lose. Sometimes they're ties, but remember, I have a death benefit and the mutual funds don't. And I don't cheat. We keep the risk tolerance in line with what the client currently owns. You gotta have your feet planted, the plan set up, everything right in place. Things are gonna come at clients in life. And in order to flip them over, you do need to have flexibility within the structure.
Couple of questions for you, just before you.
Yep.
So one comment here, and this is what makes you different than everybody else, is the comment is seg funds are not able to deduct fees.
Yeah, my normal ones don't. The private wealth management ones do because it's the way they're reported and the fees are actually broken out. So keep in mind that's non-registered plans only. Right. And yeah, you can do it with private wealth management though, not normal seg funds.
Right. Any other question I think that you answered actually in the presentation was, does changing maturity guarantee from non-registered assets from 75/75 to 75/100 trigger capital gains tax? And your answer was no.
Yeah, not with us, but most other places it would be.
Right. Perfect. All right. Well, thanks very much. That was very informative. I know we cut you off a little bit there, but we again, like I said at the beginning of this day yesterday, these are short snippet opportunities for you to show your product and get people interested in it. So in the planning phase for now, we're planning for next year's presentations and an RSP season. Obviously, we will require another hour presentation to really go through some of this material in depth with some examples, so some illustrated examples. So I look forward to that. Thanks very much, Andrew. Yeah, if you could stop sharing, and then I'll get you off the stage here and I'll set up our next presenter. Thanks a lot, Andrew. That was great.
Thank you.